This is a chart of Vietnam's GDP per capita since 1990. Over the course of 30 years, it went from $95 to over $2,700, despite its population growing by a quarter. Even after accounting for inflation and local purchasing power, Vietnam experienced a fourfold increase. Over this same period, the poverty rate has dropped from 60% to less than 5%, with the nation becoming a leading exporter. And interestingly, Samsung alone accounts for almost a quarter of the country's exports. As a result, Vietnam's economy has become the poster child for economic development, making massive gains on almost every indicator. Though how did this previously war-torn country turn it all around in the space of 30 years, being the only major Southeast Asian economy to avoid a recession in 2020? To answer this, we need to take a look at what happened to Vietnam's economy after the war. No economic video on Vietnam's meteoric rise can avoid the Vietnam War, or the American War as they call it in Hanoi. This frames the whole context of where the country is today, and most importantly, how it got here. By 1975, the nation's economic infrastructure had been destroyed by war. And at that stage, you would be forgiven for thinking that Vietnam's economy would take off in the post-war period, like so many other economies had done before. Unfortunately for Vietnam though, the country was one of the poorest on the planet, with communist 5-year plans, fixed pricing, and a focus on collectivized agriculture not exactly spurring a great economic awakening. For a long period, Moscow was Vietnam's largest trading partner, with the fully fledged communist nation joining Comecon, not to be confused with a convention hall filled with superheroes. Comecon, or the Council for Mutual Economic Assistance, was basically an economic organization to facilitate trade amongst like-minded communist nations, like Cuba or East Germany. However, by the mid-80s, Vietnam's stagnant economy was barely scraping by. It had become clear that full-blown communism wasn't living up to the expectations, and so a new plan was launched, one which would prove fundamental to Vietnam's economic rise. Y Doi Moi was a game-changer. Putting my horrendous pronunciation to one side, the 1986 Doi Moi reforms, or renovation, was a broad-based economic transformation, focused on dismantling a planned economy and opening up a closed system to international trade. The original focus was on agriculture, and this makes perfect sense, considering a staggering 70% of the workforce worked in the fields, despite the nation still being a significant recipient of food aid. The reforms moved away from collectivization and towards individual farming for a profit, where farmers were free to set their own price and keep any profits, which quickly led to a dramatic improvement in agricultural production. However, the reforms didn't stop at agriculture, as stabilizing the economy took center stage. The Vietnamese currency, the dong, was devalued and budget deficits were brought into line. At the same time, inefficient government monopolies or state-owned enterprises were scaled down, from over 12,000 in 1989 to less than 600 in 2016, through multiple rounds of restructuring, sell-offs, and mergers. This all went hand in hand with reforms to encourage private businesses, all the way down to the household level. Fast forwarding to the year 2000, a new enterprise law encouraged registration of these new household enterprises from the informal sector to the formal one. Now, it's important to see this process as one built up over time, as a transformation as opposed to a single event, which enabled employment in agriculture and state-owned enterprises to decline as private employment took off from virtually zero. A key outcome of this whole process of reform has been the seemingly unstoppable rise of Vietnam's exports, which, as this graph shows, basically tripled over the last decade, with exports accounting for over 100% of GDP. Something which can occur before you balance exports against a nation's imports. The exponential rise in exports has seen the likes of Apple, Samsung and Nike set up shop in the Southeast Asian nation, becoming the region's largest exporter of clothing and the second largest exporter of electronics, after Singapore. Though, how exactly did Vietnam go from one of the poorest economies on the planet to an exporting rising star? Economists often state that Vietnam's exporting prowess is a result of a shift in global production away from China. And whilst this trend is true, it doesn't tell us why Vietnam. Why not any of the other seemingly competing nations on China's doorstep? An oversimplified answer to this would be that foreign investors are incorporating Vietnam into their China Plus One strategy, as they've come to realize that their so-called global supply chain is largely China-centric, and hence vulnerable to unpredictable scenarios, whether that be trade wars or the great decoupling of the US and China. This is usually topped off with a statement about firms seeking to combat rising costs. After all, average manufacturing wages have tripled in the world's second largest economy over the last decade, whilst Vietnam's remains a fraction of the price. But whilst this is all true, it's, well, just a bit cut and paste. So what are the key factors to Vietnam's economic awakening? A great way to look at why Vietnam is such a good substitute for China is to consider the Export Similarity Index. This index allows us to measure how much overlap there is between two countries' exports. Going from 0 to 100, the higher the percentage, the greater the export similarity. As such, a high score implies it will be relatively easier for the substitute country to pick up the exports of the country being compared. So in a comparison of Asian countries to China on this index, Vietnam ranks first. Why may this be the case? Well, if we look at the top 10 exports of both countries, they share 7 of 10 sectors, including electrical machinery, computers, clothing, and furniture. So the fact that both countries have had great years for exports, defying the global downturn, is less of a surprise. As we mentioned in our Why China Avoided Recession video, the global change to home working has created a surge for new computers, electricals, and furniture, which, just like China, has been great news for Vietnam, as exports grew by over 10% in Q3 alone. But the similarity in exports alone, whilst important to understanding the trend, still doesn't explain the full why. As mentioned earlier, Vietnam's reform process, which started back in the mid-80s, was a gradual one. If you go through the legislation over the years, trade liberalisation stands out as a key theme, and the Vietnamese have pursued this aggressively. If you were to consider a timeline of pro-trade agreements, one of the first things Vietnam did was to create the Foreign Investment Law in 1987. This enabled foreign-owned companies to enter into its closed domestic market. In 1994, the US ended its trade embargo on Vietnam, paving the way for it to join the ASEAN Free Trade Area in 1995. In 2000, it signed a free trade agreement with the US. And most importantly perhaps, it joined the World Trade Organization in 2007, which dramatically lowered tariffs to a host of countries. More recently, it signed the Regional Comprehensive Economic Partnership, an Asian-based free trade agreement covering a third of the global economy. Overall, Vietnam has signed well over a dozen free trade agreements, being a bit of a champion when it comes to free trade-based development economics. To help capitalize on these free trading opportunities, Vietnam has invested a lot in its human capital, which goes against any preconceptions of Vietnam just being a magnet for cheap labor. According to the PISA Standard International Testing, which ranks countries by the exam scores of their 15-year-olds, Vietnam outcompetes most developed economies when it comes to reading and maths, ranking an impressive 4th for science. And investment in its population isn't just something based in the classroom. Vietnam's Human Capital Index has increased from 0.66 to 0.69 since 2010. This means that a child born today will be 69% as productive as he or she could be if they enjoyed a complete education and full health. Now, a score of 69 may not sound great, but this puts Vietnam first amongst all middle-income nations. And for context, the highest score in the world is 88, which is very much an outlier achieved by Singapore. And like so many other developing economies, Vietnam is tipped to benefit from an emerging middle class, something boosted by the nation's very high participation rate of 80%. Compared to only 65% in comparable developing countries. This high rate reflects the increased prevalence of women in the workplace, at over a quarter more than the global average, an encouraging trend which points to broader-based economic opportunities. Now, all of this is good and well, with Vietnam making remarkable progress over the last 3 decades, but it's still a far way from achieving its economic goal of becoming a high-income country by 2045. So, what are Vietnam's key challenges? A lot of Vietnam's recent success has been based on positioning itself as a relatively cheaper manufacturing base, This has provided the jobs necessary to propel the nation's economy into middle-income status. However, Vietnam is still at a relatively early stage in this transition. This expansion in jobs is threatened by increasing automation, which is set to erode Vietnam's comparative advantage in cheap labour, creating a headache in more ways than one. Because, principally, Vietnam is still an agricultural-based workforce, with just under 40% working in agriculture, and less than a quarter of the workforce possessing an employment contract. This stark subdivide between the formalised and informalised economy is a trend which carries through to foreign direct investment. A common criticism is that it facilitates economic dualism. In many cases, foreign direct investment is largely void and separate from the local economy, with the bulk of the benefits yet to merge into the domestic market. And even Vietnam's success in exports has started to gather negative attention, particularly from the US, as Vietnam has the third highest trade surplus with the States, after China and Mexico. The US Treasury Department put the nation on a list of top 10 currency manipulators early in 2020, going on to launch a Section 301 investigation, which is the exact same process they used to place tariffs on billions of dollars of Chinese imports. Something which, if ever happened to Vietnam, could seriously dent any plans to move export-orientated manufacturing out of China to service the US market. Importantly, when it comes to many developing countries, a common theme is a young population which will present a demographic dividend, and for Vietnam, over the last 30 years, its population has grown by more than 25%. But the country actually has one of the fastest aging populations on the planet. On current trends, its elderly population, which is defined as those over 65, will double from 7 to 14% by 2035, at which point Vietnam will officially be considered an aged society. The pace of this change has economists worried, being 5 years faster than Singapore. So much so that Japan, the world's leading expert in how to handle an aging population, has set up a knowledge-sharing platform with the World Bank to help Vietnam manage this transition, which will be a huge undertaking for a country which is yet to fully tread the development path so many of its neighbours have done before it. So overall, we've seen that Vietnam has made remarkable progress over the last 3 decades from an extremely low base, especially when you consider that just under 40% of the population still work in agriculture. The reforms of 1986 onwards cannot be understated, initially in agriculture and then spreading throughout the rest of the economy and society at large. It would be an oversimplification to say that Vietnam's success has been built on an exodus from China, without mentioning what has made the nation so appealing, which includes its commitment to free trade, investment in human capital, and an emerging middle class. But there is a very real concern that Vietnam won't be able to follow the same development path as so many nations did before it, due to the challenges of automation, prospects of tariffs, and one of the fastest aging populations on the planet. And now, it's over to you. Do you think Vietnam will continue its export-orientated success? Will it be able to follow the same development model as so many nations before it? Let us know your thoughts in the comments below. If you enjoyed this video, please consider leaving us a like and subscribing. And as always, see you in the next video.